Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
Hi, I'm Dr. Laura, and this is Professor Steve. And we want to talk about the big difference between investing in the stock market and investing in stocks in the market.
Mm.
If your wealth is highly concentrated in one individual stock, we caution you to listen to this video and hope you'll learn an important lesson that we've learned over the past 35 years of investing. While many people think they know more than other investors, none of us know more than the market. And
Nope.
so our focus is going to be to help you understand why.
Yep.
Now, Nobel
So this
laureate
fellow, I think he forgot his makeup for no?
Steve, he's a Nobel laureate.
Yeah,
Merton
he is.
Miller, Dr. Miller has been quoted as saying diversification is your buddy. And of
Yeah,
course, our Dr. Markowitz also talked about it being a free lunch. Diversification is a practice
yeah.
of spreading investments over a variety of assets. And, we all learned about not putting all of our eggs in one basket when we were children, but it seems like a lot of investors sometimes forget that general principle.
Problem is now we can't even afford the eggs, right?
Yes. So you've dated this video, Steve?
Yes, I
Yeah.
did.
All right. So concentrated positions, are caused by a variety of things. If you work for a company, that's probably one of the biggest. When we see people come into our office,
Yeah,
they usually have concentrated positions because they were an executive at a company. They might have gotten it through stock options, restricted stock options, or
yes.
even through other programs that the employer is offering. We'll see sometimes assets that were inherited by a parent and somebody didn't want to give them up because they were their parents' assets and
Yeah,
they've grown over time. So there's an emotional attachment to all that. Or you've done well over time. One of the big ones that we've seen more recently with a couple of our clients is they're just in love with that Apple stock because
yeah.
it's
Or
done well over
Nvidia.
time.
Yeah. You hit the lottery with a stock, and that can happen, you know. I wouldn't count on it, but it can happen.
Yeah, and Steve, maybe you want to define the what a concentrated position is, but
Yeah. And so we look at it this way, and this is also, it came from some, academic papers we've read as well, because they look at the mathematics. And it really depends on how much you have in that stock and how much of the volatility of your portfolio is affected by that one stock. And, if it represents more than 10% of your portfolio, what can happen is that single stock can represent 10 to 20% of your portfolio. I should say your portfolio volatility becomes really high when it gets above 10% because of that one stock. Okay. And so when you hit 30% or more, diversification, it really doesn't help your portfolio much at that point because that stock is just overwhelming your portfolio and it represents such a big component of it that it makes it very volatile and also very risky. And we saw that with NVIDIA, what can happen when that happens.
well,
Uh, you know, yeah,
and Steve, that's it. I mean, I think we need to recognize mathematically, when we're going to talk mathematically, you will
yep,
have the most money if you pick the stock that outperforms over the long run. And you
yep,
need to pick the starting point and you need to pick the ending point of when to get out. So it is possible. However, it's easier
yeah.
said than done.
I don't want to say mathematically because I'm mathematically challenged.
Well,
Yeah.
I
So
mean,
you,
go ahead.
oh, go ahead. I'm sorry.
No, it's just it's a matter like we're not saying that if you pick the right stock and you know exactly when to get in and you know exactly when to get out, it is
Right.
possible to outperform the market.
It is. Yep. problem is, of course, making those decisions, and that's the tough part,
Oh,
you know.
it's
Yeah,
impossible. I mean,
it is.
the real place that people have been able to do this, and it's really almost dumb luck. If you are a founder of a company, if you are a controlling shareholder,
Yes.
if you're a board member or you're actually on the executive management team, you do have an informational advantage. So you might
Yep.
actually know something that can help you pick the right stock. But for most of us, I mean, even if you've sat there and you've reviewed all the balance sheet and financial statements, which I challenge people to do, I have done that, and
I
it's
have as well.
I mean, months worth of analyzing and understanding footnotes and so
Yep.
forth. And even there, you don't necessarily know what could potentially happen.
Well, the view is, look, I'm a chartered financial analyst, and a big part of that designation was learning how to analyze balance sheets and make decisions to invest in a stock based on that. But there's a lot of problems with that. First of all, the market is very efficient. So if you think you're going to somehow gain an edge by doing that, the theory is that most of the information that's publicly available is already priced into the price of the stock. So it's very hard to try to look at a balance sheet and gain some kind of insight that perhaps no one else was able to capture, especially when you have probably tens of thousands of people all looking at those balance sheets together.
Even
It's very hard.
the professional,
Yeah.
the analysts that they pour over
Yep.
one single company for days and months and years don't
Yep.
always call it. One of the examples, actually, I don't know if you know this, Steve, but when Enron went bankrupt,
Hmm.
6 weeks before they went bankrupt, 12 out of the 15 analysts were saying it's a strong buy. I mean, the
Yeah.
problem is there are risks that we face as investors, which include things like fraud, poor
Well, I was
decision
just going to say
making,
that. That
all
was,
that.
yes.
We
Yep.
it's very, very hard to really identify, and there are more risks than we can even count. There's just
Yeah, there was a great book on Enron in particular, which I did read. I read it about probably 10, 12 years ago. I think it was called The Smartest Guys in a Room. Is that the name
uh-huh,
of the book? I think.
uh-huh.
And I highly recommend anybody who's really interested to read that book. And the things they did were stunning. It was stunning. It was so much fraud involved in that firm. So, and actually led to some changes in the laws after what happened to them. So,
Yeah,
so
more
anyway,
regulation.
I'm sorry, Laura, go ahead.
No, I just said more regulation. But
Yeah, more regulation.
you can throw all kinds of regulation on top of regulation on top of regulation. And if people
Yep,
are going to behave inappropriately or execute fraud, there are ways of circling around.
always. Yep. Can't stop it. I don't care. You can't stop it in the long run. Yeah. And so anyway, the implications, you have to have at least 10 stocks to avoid over-concentrate positions. But obviously, I think in reality, you need 40 or 50 if you really want to be properly diversified with individual stocks. But as we're going to show you, that doesn't just mean you can buy 40, 50 stocks and sit there and not even pay attention to them. You gotta watch them, and that's the other issue here too. And we're going to show you that, quite honestly.
Yeah, I'd be careful with even that little amount of stocks. You better know. I
Yep.
mean, that's for a Warren Buffett who has a whole team of analysts who have poured over things and like, somebody that really has the ability. I don't know if the average person is even defensive enough by that. And that's because of the unique risks associated with each of these businesses.
Yeah, and companies have risks that are very specific to them, and the key to this is you're not compensated for that risk by the market, by the way. You don't receive any additional return in the long run by taking on risk that's unique to a firm. You're compensated, and this comes out of academic studies and everything else going back out to the 1960s, I think originally. You're compensated by taking the risk of the stock market as a whole, not by taking a risk that's unique to a particular company. And we just outlined some of the risks here. The risk of the company, the business they're in, and like we might have seen some of that with NVIDIA, 2 weeks ago. They're in frankly, a business area that's really going to be subject to a lot of competition probably in the near future. I think we misspelled with. I just noticed that. That's probably my fault. And operational risk. You lose a key employee. Somebody has, really has created a lot of your intellectual property, perhaps, or a factory burned down as an example here. They could go bankrupt for other reasons. Just weren't managed properly. They could be too, heavily over leveraged in debt. That's another reason. And suddenly their profits drop and they can't service their debt, properly. And also legal risks. We've seen a lot of that too, new laws, regulations. So,
Absolutely.
yeah,
And, at the end of the day, when you're investing in a single stock, you are gambling. You're not investing.
no,
And, that's fine as long as you don't mind losing your money because it happens all the time. I mean, most recently, I think one of the most recent ones that we saw that came at a big surprise was in 2023. We saw First Republic. Um, so First Republic was
yeah,
added to the S&P in 2018, but by May of 2023, it you lost all your money in it. So very, very, and what's interesting is even during that period of time. So by June, I remember looking at this by the end of June of 2023, the stock market itself, the index was up by 10%. So it barely felt that one particular company. And that's the whole idea when you diversify
yep,
and you have all your assets in one basket, even if something does go under, you're not affected that much because you have enough other things involved in your portfolio.
that's correct. Exactly right. Yep. So the impact is not as dramatic.
Hmm,
So this is actually an important slide. It shows some stocks that were considered, I think, stocks you couldn't miss on back in the year
really.
2000, right? But,
Yep.
pretty much they all missed. If you held them over this time period, which is 15 years. And I remember Cisco in particular, it was a high-flying stock at the beginning of the internet era, in the late 90s and around year 2000, it had a price to earnings ratio of about 140, 150. And so any future earnings growth was really factored into that price of that stock. So you had very little potential for profit because it was already factored into it
Right.
there.
Right.
And so look what happened over that 15-year period. Cisco actually went down by 48%, believe it or not,
Yeah.
over that
A
entire
lot of
time
it went
period.
down like early on and it just stayed down. So, for all
Yeah,
those people that say, oh, I know that if I just hold on and I'm just patient, it eventually
right.
goes up. And while you're invested in the global markets, in general, the global markets always return, but individual stocks don't always return. I mean, look at
No.
Microsoft, for example. If you bought
Yeah,
it in 2000, would you have had the wherewithal to sit there and
right.
not do anything for 15 years? I mean, most people would have sold it. And so, it went
And
down.
let's look at what happened, right?
Yeah, it started coming up, but then it actually did come up in by 2025, last month of 2025, or I think it was February 9th, so a couple days ago,
Yeah.
it was up significantly over that past 25 years. But if you take that 622 and divide it by 25, it's somewhere around a 24% return. So we would
Right.
argue that, gee, 24% return for the level of risk that you just took. Yeah, you better get at least 24% because I guarantee you there are a lot of people that bought and sold this stock at the wrong time, including in 2022 when it completely look at the decline
Yep.
for to
COVID. I think that was
2023.
COVID. Or no, that was actually after COVID. That was 2022. You're right. Yep.
Yeah, yeah. And
And look, you look at all that return came in about 5 years,
yeah,
effectively.
yeah, yeah. And
You
we'll see
know,
what happens because it's a volatile stock, clearly. Um,
and look at the other sad sack stocks there.
there's three of them that have never ever come back: Intel, Citi, and GE. And Steve, I was working with somebody back in 2007 who was actually an executive at Citigroup. He was an MBA. He understood risk. He knew it was a bad idea to hold too much stock, too
Mm,
much of his company shares, also because he was employed there. But he got them at a low basis and he didn't want to have capital gains. And so,
Yeah.
I even remember him telling me in 2007 that he thought something wasn't right with the excesses in the housing market. And he also knew what was happening in his company around the mortgage securitizations and all of that. But what's so fascinating to me is that his knowledge of what was happening gave him a false sense of confidence. He
Right.
actually, that
Yep.
knowledge was actually dangerous to him because he didn't see the full picture of what was happening. And so, at that time, he could have had capital gains. Now he doesn't have capital gains. I mean, the stock went down by like 90% and has somewhat
Yeah.
come up a little, but it's still down 83%. Like he's basically never recovered.
I knew of a couple people that actually were working for Cisco and they exercised stock options. What happens when we're not going to get into too much of the details about stock options. That's just for another video, but you exercise them and they held the stock. But when you exercise stock options, you have to pay income tax on the difference between the market price and the exercise price. And it's treated as ordinary income. So they had a big tax liability. But then after that, within the year, the stock dropped. And now they still had that tax liability. The stock wasn't worth anywhere near what they exercised it at, yet they still owed that tax. And a couple of people had to declare bankruptcy because they couldn't afford to pay the tax. So, even with stock options, exercising and retaining can be very dangerous.
Right.
So,
Yeah. And Um, you can go to the next slide, Steve, because this is actually
yeah,
tying what I was going to say was ties into this next slide.
yeah.
Is that a lot of people will say, "Oh, well, those are just a couple of stocks, and good thing I didn't invest in those stocks." But
Mm,
I've picked my own, golden boys, or if you will, type of
mm.
stocks, and I'm going to be fine. But when I think about all of the stock, like Blockbusters, Sears, Xerox,
Oh, yeah.
Borders, Toys R Us, Yahoo,
Kodak.
Kodak. See, I mean, I can just like rattle off. Like, if you
Yep.
want me to rattle off 50 companies that I thought were good companies over the time when we were investing, I mean, just off the top of my head, I mean, there there are more stocks that have trouble than not. And this slide that you got, Steve, just really says it all.
And this came from research, and look, we had good feel for these numbers, but even we were stunned when we read some of the academic
Yeah.
research related to this. And something I think I read last summer triggered us to do some more research in this area, and we came up with a lot of very interesting statistics. And by the way, we're going to introduce a couple of mathematical concepts we understand it intellectually, but it's hard to verbalize properly the right way to explain it. But we'll do a pretty decent job at explaining it. And the key really is, which we're going to show you in a second, is that you look at the average stock return for the market as a whole, it's been about 11% since 1926. But the problem is the average, it gets skewed by some really high performing stocks. But have been a lot of stocks that haven't really performed anywhere near that annualized return of 11% a year. And so, yep, go ahead, Laura.
No, it's just when you showed me this, Steve, we were talking about this. I actually didn't believe it, and I said, no, this can't be true. And so I
I
had
know.
to go back and I was like, Steve, are you sure you've read this right? Are you sure? But it really, this is saying that only 4% of the stocks that from 1926 for the past 100 years actually gave positive return.
And so we did footnote the research papers, and if anyone's interested, I'm happy to send it to you. And they are readily available on the internet. But if you want to, email us or call us, I'm happy to send it to you. It is a good solid academic research, which is the only thing Laura and I will look at. So, so the concept that's hard to explain, we do have an example that hopefully makes it a little clearer, is the idea of median versus average. So average means you take all the returns of all the stocks, add them together and divide it by the total number. That's the statistical average. But the median is different. It says, all right, where's the splitting point? In other words, where do you cut the baby in half
Where are the
effectively?
most occurrences?
That's correct. Yep. And so if there are more occurrences of negatively or stocks that have negative returns, in relation to those that had positive returns, then the median is much less than the average. So you had a number of stocks. In the other case, we saw like 60 or 70% had a negative return. So that pulls the median way down, but you had some high-flying stocks that pulled the average up. So in other words, that return of 11% wasn't really evenly averaged over all the stocks that were available over that period of time. And so here's an example of that, which I created. And
Well,
these are
let's
actually
go
interesting
back to
comp.
that slide. Since you showed it,
Yeah.
I struggle with even showing everybody this. I know we have clients
Mm,
that love statistics, and we have other clients
yeah.
that prefer to forget whatever they learned in statistics. But
Yeah.
these little curves, if you will, are they show distributions over time. And so the middle one shows if in fact distributions were evenly distributed. In other words, if you saw returns that were equally, some of them were on the right-hand side of the average and some of them were on the left-hand side of the average,
Yeah.
that would be an equal distribution. But we know that that's not the way returns are distributed. They really are more
Nope.
on the left-hand side positively skewed, which means that the bad returns are really, really bad. Um, and
Yes.
on the right-hand side, there's more of a glide path. And you can see that if we always say that the mean is what our expectation is going to be, we're overstating what we think we're going to get in terms of return. And there's danger in that because
Yeah.
you're not really looking at it realistically. So now you can go to the next slide.
And so, by the way, if you're interested in any of these stocks, I recommend them. There's a hot tip, especially
He
Mars
made them
Airlines.
up. These are an example. He made them up.
Yeah, well, Mars Airlines, well, that could actually be SpaceX eventually, right? He wants to go to Mars,
Quickly.
right?
Yeah.
But you'll see that on the column on the left that the wide range of potential returns, which more models you're going to see later on, is actually models the market pretty closely. You had some stocks that did really terrible, and you had some ones that did really fantastic, and hardly anything in the middle. Whereas the column on the right shows you what most people think the market really looks like, which isn't realistic. And you'll see that the average for both of these occurrences are both 6% if you average up these stocks, their total return over the period of time we have here. But the median for the one on the left is only 4%. So in other words, more than half the stocks provided a return of 4% or less. And one on the right, you see that the median is actually above the average, which means that more than half the stocks provided a return above the average. But the column on the left is really how the market actually really looks. So. And I hope this makes a little clearer. And anybody wants these slides, we're happy to send them to you as
Or
well.
further explanation. Go
Yeah.
on. Because it does get a little, but I think that the way you explained it is good.
Okay. I'm not sure I understand it. Come on. But yeah, I think Wingless Planes is a very good company too, by the way. So anyway, here's some shocking statistics. And even from the last, from that time period, 24 years, right? Of 3,000 stocks, 40%, 39% lost money over that 24-year period. And this actually plays to that table we just showed you. 19% lost 75% of their value, which is amazing. 64% underperformed the index, and only 25% contributed to all the market's gains. And
Right.
again, we didn't make these numbers up. It comes from an academic paper. And you
And
can
the
see it.
Russell 3000 is we talk about the S&P 500, which is the top largest stocks. The Russell
Yeah.
3000 is 3,000 domestic stocks throughout our country, which include large cap, mid cap, and small cap. So we feel like it's a better representation of the domestic market. So just wanted to make sure
And
that,
I think nowadays that represents most of the listed stocks. I think it's
yeah,
down to about 3,000 or so. At one point, it was over 6,000, but the number of listed stocks has declined
right.
dramatically, by the way.
Yeah, they've been acquired and so forth, which actually, so I saw a number similar to this actually was since 1955. So it really is over the past 70 years. Um,
Hmm.
88% of the companies in the S&P 500, so those 500 companies, 88% don't exist anymore. 12% exist.
And we actually have a chart that kind of is going to show that, but it doesn't quite go back to the 50s. But that number, that's definitely about the right trend.
Yeah.
And so we got this information from a mutual fund family. We use a couple of their funds, Dimensional Fund Advisors, DFA. And this is interesting. This is typical. About a fifth of stocks actually survive and outperform the market over any 20-year period. Again, this plays back to that chart we showed you earlier that we created. Stocks do get delisted at a high rate, even stocks that outperform. And a lot of times they may be delisted because of a merger, and doesn't always necessarily mean they went out of business. We have statistics which will show you that a little more clearly. On average, about 30% stocks outperformed. Um, that outperformed over the last 20 years actually continued to outperform over the next 10. So that's an important statistic. So it's amazing that only 30% continue to outperform over the next 10 years. So in other words, trying to project what's going to happen in the future, it just because it outperformed in the past doesn't mean it will in the future. You can't do that. And 30% that underperformed, and this actually leads to that chart you showed of Microsoft, right? Underperformed. Then suddenly it outperformed for the next 10 years.
Yeah.
You,
You
you,
pick when to
you,
get in and when to get out. Just let me know.
yeah. Yeah, you just can't guess. And winners are not more likely to lose to beat the market in the future. And that is an important statistic. And that actually shows that most active managers in the long run can't beat their benchmark, so yeah. And so, from 1926 to 2019, this is stunning. Five companies account for almost 12% of net stock market wealth creation. That is stunning. I mean, when we first I saw this, in an academic study, I was stunned myself. I mean, we've always been diversified in our client portfolios, but this is really stunning. 83 firms accounted for half of stock market wealth creation. And in the 3-year period, ending in June 2023, five companies accounted for 22% of net wealth creation, which plays into those what, 7 or 10 companies that represent so much of the S&P now. I mean, if this doesn't convince you that you shouldn't have a concentrated stock position, I don't know what will.
Right. And Steve, one of the things that I think that it's important to mention is that the way we invest for you
Mm,
clients, we take a look at all the underlying holdings of each of the different kinds of funds we hold.
yep,
And I don't think we've ever had more than like 0.4%
that's right.
of any
Yeah,
individual holding. And we continue to test that and make sure that
yep.
we're not, because a lot of times we'll have people that come with positions, say this fund and this fund and this fund and this fund, and they think they're
Hmm.
diversified. And when we do that X-ray or overlap report, we find out, well, no, each of the funds are holding very similar uh, underlying stocks, and
Yes.
you're not getting that diversification that you think you're getting. So it's
Yeah.
an important part of our analysis.
And the other times you have to be careful if you want to have an active manager. You want to look at what a lot of people in the profession call active share. Are they really managing it, or are they just a closet indexer? And I think in the long run, a lot of active managers are going to they'll gradually move toward being a closet index because they realize they really can't beat the market. But they want to retain their asset base. And if they're underperforming the market, they're going to gradually lose it. So they're going to move more and more toward the index through time. And so now you're paying a high rate for what's effectively an index fund, quite honestly.
So what we actually are seeing, Steve, is the people that really understand this and know what they're doing. A lot of the PhDs are actually practicing in the business. They'll do kind of like almost like a core and satellite where they
Hmm.
basically expose their clients to the overall broad market, and they might take some gambling types of, you know, bets to
Hmm.
generate some additional alpha, but
Right.
they don't just blanketly go you know, they're not that blatant. They've learned to be humble. They've seen what happens.
Yeah, it's a good point. That really is. And so important question. What happens to stocks that seem to be really seem to be high growth stocks? And use Cisco as the example. I always remember the article in the Wall Street Journal when they had a price earnings ratio of 140, and somebody analyzed it and said, gee, to justify that price to earnings ratio, that stock, their earnings will have to grow 35% a year for the next 10 years. But the problem is when you compound those earnings over time, we're going to show you an example of what happens if you continue to do that. So there's limits to a company when they reach these high growth
And
rates.
so listen to what Steve's saying. He's talking about Cisco's positioning, and we saw what Cisco did on that last chart we showed, um,
Yeah,
which demonstrated that their PE ratio was a fantasy. I just want to.
I'm glad you mentioned exactly right. And so what also happens is other companies say, gee, this company, they're earning outside profits. Maybe we can get into that same market. So now competition starts to increase, and we just saw it rear its ugly head with Nvidia. We don't know if it's real or not, but what happened, about 2 weeks ago, Nvidia dropped about 17% in a day because of that company. I think it's DeepSeek. It looks like they could, cut into Nvidia's into the market they're in. And a lot of companies like Nvidia initially they have what's called a moat. There's a high barrier to entry for another company to get in and get some of those profits and pull them away from them by providing competition. But eventually that moat declines through time for a
We
lot of
know
reasons.
several companies that are competitors of NVIDIA that are
Yep.
coming out with chips that are supposedly bigger,
Yep.
stronger, more. And one of them actually we hold in our private shares that and it's also has some Chinese funding, which is interesting. Um,
Yeah. Yeah. And so what we did is, so there's a couple of reasons. There's a mathematical issue, and there's also the fact that other companies jump in because they see that those extreme profits that a company's making. So they see, wow, that's a great opportunity. Let's figure out how to get into that market. But it's also the mathematical issue. So we created this chart to show you what happens mathematically. And so on the left-hand side, we show you the basic parameters we're using here. U.S. Gross domestic product is 29 trillion, and that's about right. It's right around the right number. When I did this, I think sometime in the fall, uh, I took as a sample a company around the same sales level as NVIDIA, about 30 billion, and we assumed the growth in sales is 40% a year. And if you look at some of the price earnings ratio for something like Cisco or even NVIDIA, that may be kind of embedded within that price earnings ratio, that assumption. Now, if you look at initially, that company may represent only a tenth of GDP. I'm sorry, 100th of 1% of a tenth of 1% of GDP. Okay, at that level, 30 billion in sales and 29 trillion economy. But in 10 years, at that growth rate, that company here represents 2% of GDP. If you go to 15 years, now look at this, it's accelerating because it's compounding each year. Suddenly now in 15 years, which is 2039, it's 11% of GDP. And we know that can't happen. We we know there's no product that's probably other than maybe some form of energy, and not from just one company, by the way, that's going to become 11% of GDP. I mean, it's just mathematically impossible, pretty much.
right. Although the PE ratio says it's going to happen.
Yeah, that's the point. Yep. And so this is just kind of illustrates that prior chart, and the curve going up shows you the percent of that company's sales in relation to GDP, and you can see the way it accelerates as the compound because of the compounding. So we just know it's not possible. There's a limit to growth, and so that's another problem with trying to pick and choose some of these companies that seem to be high flying companies in the long run. And this chart actually plays back to the one we showed you earlier with the fake companies I made up, showing you the distribution of returns of stocks. And you can see that, and this is real. This shows you that one out of every five stocks was a significant loser from 1983 to 2006. And 39% of all stocks had a negative total return, which is stunning. And only one out of every five stocks was a significant winner, and 61% of all stocks had a positive total return. But you see how that skew that exists here, how many had a really high return and how many had a really negative return. It's amazing.
Yeah, and so everybody wants to pick that the stocks in that right-hand bar. Um,
Yep.
it's not as easy to do as people think.
No, it's not. And here's another issue is that what's happened over stocks from 1927 to 1920 to 2020. I mean, 40 over the average, this is the average 5, 10, or 20-year period. Over the average 20-year period, only 47% survived. About half were delisted. In other words, they weren't even listed as on the stock market any longer. But of that 52%, roughly 34% were good delists. Perhaps it was a merger, so they were no longer in existence because they merged with another company. But 18% now, the 18 and the 34 add together, by the way, it roughly adds up to the 52%. But 18% were bad delists, which means the company probably may have gone bankrupt. Something happened to them that was bad over the average 20-year period. In other words, roughly one out of every five stocks actually had something bad happen to them, were no longer part of the market. And only about a fifth survived and outperformed the market over the average 20-year period. Okay.
So Steve wanted me to explain this because
Yeah.
I have a psychology background. However,
And
you know,
yeah, and I need help in that area.
there are a lot of behavioral reasons why people choose to stay in concentrated positions. Suffice it to say, to me, it really boils down to two major issues. One is that they don't want to recognize the taxes, though unfortunately, allowing the tax tail to wag the dog is never a good answer because you can wind up like
Yeah.
my friend from a Citigroup that wound up with no capital gains because he had no gains at all.
Yeah.
So you want to be careful about making your decision just about taxes. But the second thing is that people think that they have some kind of ability to pick and choose the right stock based upon a lot of different false data and false interpretations of data that give them this warm feeling, which is not appropriate. And so um,
Yeah.
the first issue, the tax consequences, we can help people work that through. The second issue, all we can do is show you the information that we've shown you from the studies we've shown you. And if you choose to stay in a concentrated position, well, good luck with that. You might be successful, but
Yeah.
we feel like it's irresponsible for us not to let you know that you are taking on risks beyond what we would recommend.
Yep, yep. It's a lottery effect. You hear about the billion-dollar winner. You say, "Gee, I want to buy that lottery ticket because I could be that person."
Yeah.
And you may get lucky with a stock. And many of our clients have, but we don't hear the stories about many who haven't and have lost a lot of money. A lot of times you don't hear those stories.
So you don't. People don't tell those stories.
Yep,
So again, the biggest thing for people that are rational and they say, look, I understand that I'm holding too much risk and I know, but I'm concerned about the taxes. There are some things that can be done, and we have helped clients with a variety of different strategies. Um, there's just some for some people, they choose to just hold their nose and sell the stock and take the taxes and just diversify because they just don't want to expose themselves when they realize the
yep,
exposure. Um, for other people, we help them liquidate over time. But for some other people that have some more either are in the position to take on a little bit more sophisticated strategies. We have introduced some kind of satellite strategies in helping them navigate outside of it. One of the things by especially partnering now with the firm that we merged with, we've also opened up the door for having
yep,
strategies better managed too. That has given us additional options. So things like covered call writing is quite interesting, which is the option strategy, or even direct indexing or amplifying the direct indexing. We've done some charitable giving types of things with people as well. The exchange funds, we're not crazy about exchange funds because there's a
No.
7-year lockup. There are pros and cons to each one of these. So if you are sitting in a concentrated position, you are concerned about taxes, we can talk to you about all the pros and cons of each of these strategies. We're
Yep.
particularly interested right now in this direct indexing amplification because we are
Yeah.
working with the firm WEG and another firm that is full of some academic PhD folks who have created some interesting strategies around harvesting losses while maintaining parts of the market where there are gains. The strategy doesn't actually eliminate gains, it more more defers gains to a
Hmm.
later time. So, for
Yes.
example, if you're in an income earning years right now, maybe you want to defer them out later in life, or maybe you're older and you're thinking that your family is going to eventually inherit your portfolio
Yes.
and get
Yep.
that step up in basis, but you're not that old. You could be around for another 10, 15 years or whatever. And you don't want to sit in that risky position. There are ways of positioning it so that at least we can create some more diversification. And then, yeah,
Yeah.
when your
Yeah.
children inherit it, they get the step up.
And I want to mention one other. If you're a husband and wife and one spouse is not that healthy, what you could do is you could use a strategy like that and move everything into the spouse's name who isn't healthy. As long as you have you know they're going to live longer than a year. What happens then? You can get the remaining spouse can get a step up in basis on the holdings that in that spouse's name.
Yeah, that's a
Uh,
little tricky
yep.
because it does create some exposure. Sometimes
Yep.
what you want to do, one of the things that we've seen people do where they've had all the growth in one spouse's portfolio is at
Yeah.
least to even it out so that
Yep.
holding it in some of it in his portfolio and some of it in hers,
Balance it out.
whatever. And then when the whoever does go first, at least half of it gets that step up. So there are some
That's right.
to do there. Yeah.
Yep. That's a really good point.
Oh, this just talks a little bit about that direct indexing and the amplification of it and the whole idea. I don't know if I want to go through it too much, but it really
No.
does take into account whether you have capital gains in either an asset like a stock or even a business or real estate.
Yeah.
It's a way
Yep.
of generating losses to put against those gains so that you can uh, push the tax obligation off into the future. And
Defer.
it's a
Yep.
very, very interesting strategy.
Yeah.
And we have introduced it to some people that we thought would really benefit from it. If somebody is interested in it, we are concerned about the fact that we want to make sure that the individual is aware enough to understand what we're talking about. It does
Yes.
require a larger portfolio, so you
It's
know,
not for everyone,
right. But
but for the right person, could be quite helpful.
right. And I think that's at the end of the day, in summarizing all these solutions, I think, it's not an exhaustive list what we just showed you, but they are potential solutions that we've been looking at and using. And sometimes it could be a combination, but the thing is that we need to understand the nuances of your situation and try to
Yep.
direct you so that we can offer the best recommendation.
And I just want to summarize by saying, the risk you take by having a concentrated position, granted, you may owe some tax, even if you don't use these strategies, but in the long run, is it really worth the risk? Because you see what can happen in the stock market.
So, as always, we are always open to your thoughts and suggestions. If you want to have an argument about concentrated positions or any of those things, we love to discuss this. This is clearly Steve and I have fun with discussing these different aspects of investing and what can be done about it. So please feel free to give us a call or send us an email. Thank you, and looking forward to talking to you soon. Bye.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.